How's it going, guys? In this video, I'm going to explain to you what index funds are, how you can become a millionaire investing through them, as well as why the earlier you start, the better off you will be. So first, let me give you an explanation of what exactly index funds are. Index funds can be either mutual funds or ETFs, and mainly they're designed to track a specific index or specific industry. A mutual fund is when a money manager pulls money from a group of investors and then uses that money to purchase securities or use some specific strategy that might be difficult for the individual investors to do themselves. The main difference between a mutual fund and an ETF is that an ETF can be traded at any time when the markets are open. And typically mutual funds can only be bought or sold at the end of the day. Now there are different types of mutual funds like open-end and closed-end funds, but we'll save that for another video. So there could be index funds that track super specific industries, or there could be more broad index funds that track something like the S&P 500 or the Dow Jones or the NASDAQ. The biggest benefit to investing in these index funds is that you can invest passively, especially if you're investing in these broader indexes. If you're investing and you're purchasing individual stocks, that's what's called active management or active investing. And as an analyst for a student hedge fund, I can definitely tell you there's a lot that goes into active investing. First, you have to understand what the company does, what industry it is in, and how does it make money. You also have to understand the industry trends and their competitors and see how they're positioned. You have to understand the current health of the company. That way you come up with a value for the company. And once you have that information, you compare it to the current stock price to see if it's overvalued or undervalued and whether it makes sense to buy. So what this means is that you have to know something about the company that the market doesn't know, which is difficult. Or you have to understand something about the company that the market doesn't understand, which is still difficult. And even then, you can still get it wrong about a stock. You can even go out there and look up some of these analyst ratings about companies. They'll give you like a buy or sell rating, as well as a share price of what they think it's worth. And for some companies, it's a huge difference. So let me say, for example, let's say Tesla. There could be analysts out there that are pricing Tesla at around $500 or $600 a share. And there might be other analysts that are pricing it at $1,000 a share. So even with professionals, there's this huge difference on whether it's a good stock to buy or a good one to sell. So now I'm going to show you the benefits of passive investing, especially for the long term, and why it's easy for any beginner to get into this. So let's assume for this example, you're using a Roth IRA. And one of the benefits of using this type of account is that the money is growing tax-free. So because you're using after-tax dollars to fund it, when you go to withdraw money, it is tax-free. So you don't have to worry about paying any additional taxes when you withdraw it. So let's say that you're starting with $1 million, or your target is $1 million, I should say, and you're starting with $0. And let's take me, for example. I'm 20 years old and I'm able to start withdrawing for any reason from that account when I am 59 and a half. So let's say I have, here we go, 39 years. And we're going to use an 8% return. And the reason why I'm using 8% is that historically the S&P 500 has returned about 10%. But I think that's a bit too optimistic, so we're just going to use 8% for this example. So this is going to tell us, based off of $1 million target, starting with nothing, and 39 years at 8% return. It's going to tell us how much we have to contribute at the end of each month to reach $1 million. And that means that right here, we have to contribute $336.59. So one of the benefits of this site is that it also gives you a breakdown. So the money we contributed, so $336.59 times 12 months times 39 years is this number right here, the $157,524.52 that we're actually contributing to it. And this is how much has grown because of it. So here's another graphic breakdown of it. So 84% is the actual earn. So this is basically your money is making money. And here's another example of it. So the reason why it's so important to start as early as possible is because let's say I decided to wait until I am 30 years old. So instead of 39 years, I have 29 years to grow. So we're going from a monthly contribution of $336 to $773. And the issue with this, at least with using a Roth IRA, is that until you reach 50 years old, the maximum contribution a year is $6,000. So you can only contribute, if you're doing monthly, a maximum of $500. So we wouldn't be able to hit this goal if we waited till 30. Also, looking at this, you'll see that instead of 84% or 85%, which was before, of interest earned, it is down to 73.1%. So because we're giving our money less time to grow, our contributions is going to make up a higher percentage of our total account. So if we did these things, then at the end, when we're eligible to start withdrawing money for any reason, we'll have an ending balance of $1,485,484. So as you can see, we're contributing about $234,000, and our interest earned is over $1 million. And let's say we waited until we were 30 and did the same thing, we would only end up with $646,000. So starting 10 years earlier more than doubled our return. Or should I say, if I were to start 10 years later, that means I will make less than half of what I would have if I started at right now. So now a final way to look at this is the investment length, or how long it will take us to reach $1 million. So if our target is that $1 million and starting off with nothing, and 8% return contributing $500 a month, which would be the max of $6,000 a year, it would take us 34 years to reach $1 million. Now I want you to think about something, and this is going to illustrate the super importance of compound interest, is that it's taking us 34 years, a little bit over 34 years to reach the $1 million. Yet it takes us 39 years to reach just under $1.5 million. So 34 years for it to grow to $1 million, and an extra 5 years to grow an extra almost $500,000. Because what we're doing here is giving our money more time to grow. So literally just continuing to put money into these funds either every week or every month is super easy to do, and it will definitely pay off for you. So if you're new to the channel, make sure you like that button down below and subscribe, as there will be lots of new content coming in, so stay tuned.